one of the presentations that I do to teach agents and professionals how to present the mortgage situation dilemma. And it is a dilemma because we transfer too much wealth unknowingly and unnecessarily in the mortgage payment business. So my desire is to educate you so you don't make financial decisions. So right now, I'm going to turn off my camcorder so you're not looking at me. We're looking at just the software. And now we're going to begin. What do we desire? We desire no risk. We desire a plan that works, one that's maximizing our every effort, minimizing taxes, and reducing our lost opportunities or our costs that we incur while we're going through life and spending money at the same time trying to save money. But we need a platform. We need something to run on because our financial decisions are done one at a time with different people and under different circumstances. There's no coordination. It's like the junk drawer in the kitchen. Bunch of stuff. We don't even know how it fits. The junk drawer is not a good, efficient, or effective way to do things. My desire is to bring you beyond that to, first of all, identify the rules of the game. They are made up by the players, the ones who create the products and the other vehicles that we use. We need to know their rules. It's like playing Monopoly and you don't have a game board. It wouldn't be too healthy for anybody. The confusion would be just like we have now in our financial decisions. And money is different than a lot of things, but it's very much like oranges. If you took oranges and you put them under your sink and came back in a year, what would they look like? Well, money erodes too. One effective way is inflation, as you see on the screen here. It's a 3% average, let's say. Well, if that's the case, the dollar today is the most powerful dollar you have. But the dollar of 30 years at a 3% inflation only buys 47 cents worth of goods. Money needs to be moved. And just like oranges, we cannot stick it in some place and hope to come back and it's going to be there or it's going to even resemble what we wanted. So the solution comes down to a very simple process that we established a game board. We learned the rule book, and now we're working with a macro manager. What's the macro manager? He's the conductor. Can you imagine the orchestra and nobody's up front? Well, a financial plan with nobody orchestrating the moves is similar. That's why we end up with junk draws. We need to make clear, concise decisions. This is Circle of Wealth software. Very, very powerful tool to teach, and that's what I'm about to do. There's 5 questions that are going to be put in front of your screen right now. If you would just pay attention to the question and answer it as you would answer it as you will answer it. A large down payment will save you money over time versus a small down payment. 15-year mortgage will save you money over 30. Making extra payments saves you money. The interest rate is a main factor in determining the cost of a mortgage. And this last one, that you're more secure having the house paid off instead of being financed at 100%. Well, I'm going to answer that one in this way because I'm going to go to the last one and it'll help your thinking when we're coming through the rest of these. Well, somebody says, I have my house paid off, I feel safe, I feel secure is the word here. And I ask them, well, what if the emergency came up? What if your 401k market had dropped, you're disabled, you lost your job, the family member that needs surgery, the money may be needed? Could you get it in every circumstance? Usually the answer is sure, just go get a mortgage. Well, no, you got to qualify with a 5-page questionnaire these days. And only if you can pay that mortgage can you get that mortgage. So you are not in control of having that, and you shouldn't feel as comfortable as you really do. It's a false sense of fear, and you're not being effective with your money, but you may not be able to get at your money. So let's move on. Why are there so many kinds of mortgages? Well, the banks are marketing geniuses. The 30-year mortgage is the original, the vanilla, the one without sprinkles, and the rest of this stuff is just tools that they've implemented so people make decisions and they get sometimes caught and sometimes just expense. Let's talk about the biweekly payment, and let's talk about monthly payments. Let's talk about the bank real quickly. If you were a banker and you owned the bank and somebody was interviewing you and said, Mr. Banker, what would you like people to do with their money in order for you to be a success? Because really, it's none of your money, is it? No, no, it's not our money. It's always clients' money, and I want them sending that money to me. And how often would you like it sent to you? Well, I'd like it sent to me as often as possible. So weekly? Oh, that'd be ideal. But biweekly payments on a mortgage, that helps us. It gets our money into our institution, and then we start to earn money. Oh, okay. Now, how long would you like that money to stay in your institution? Well, I'm a banker. I want it to stay forever. Well, why would they do that, Mr. Banker? Compound interest. Oh, I see. So they'll stay because they're going to make money. Absolutely. And we can charge them fees, and we can utilize their money, and that's how we grow our business. Oh, now at the end of the game, this is their money, and they want it back. They're going to enjoy life. How would you give it to them? Well, I don't want them to have it. I'm out of business if I give up their money. So I would give it back to them as little as possible. Well, good. That was for your benefit. We need to understand who we're dealing with. A banker is a business person, and they answer to stockholders. So the principles that we're learning may not always be the truth. So, and they don't know it many times. I am not saying anything about the character of a banker. What if what you found out to be true was not? When would you like to know the answer? Well, most people would say, I'd like to know it immediately. Of course you would, because it's something that's going to hurt you. But you found out what you knew to be true is not. So now you need to open up your eyes, and you got to get a bigger box to be able to contain the thinking that you've just adopted. You've come to a critical point. Your island has been blown up, and now you need to think differently. We're going to talk about a kind of money that's not talked about a lot, and it's the transferred money, as you see on the screen. I think the other two are pretty clear. These are your savings, and this is what takes you to live. But transferred money is different. We transfer money through all of these different vehicles. There are actually 27 of them in total, I think. But all of these things will cost us money if we purchase them incorrectly. It's not what we buy, it's how we buy it. So let's talk about wealth transfers. Can they occur? No matter how we make a decision? Yes. If we finance, you will transfer interest to the lending institution for the privilege of using your money. We understand that. The reason that we don't want to do that is that we don't like paying that interest. So if you pay cash, you save the interest that you're paying to the institution. However, now you begin to lose interest on your money because you are self-financing. You took the money that was earning interest out of the interest-bearing vehicle and put it into the house, the equity, the wood, the fixtures, the foyer, the driveway. And there's no interest, there's no dividends from those vehicles. But it was a decision. But you either pay interest or you lose interest. Unfortunately, there isn't any other way. Why do we have a mortgage in the beginning? Well, first answer is because we don't have enough money to buy it on our own. The second is the tax deductions. They are favorable, and it is a good tool. It's a real deduction. In fact, tax deduction is not like a 401k, which is a tax-deferred, delayed, postponed tax for the future. This one, when you file your taxes, you get the credit in April and whenever your date is, and the money is in your account. You kept it. It's a real deduction. So the benefits of this is that if you have a phase-out, as you can see, the new filings, the exemptions, we have some rules here, but we still have a tool that we can use. And the third one is the potential spread between what you borrow and what you earn. And that is the big factor that will make us make different decisions. Let's talk about inflation first. We said it earlier that at 3% inflation, a dollar is only 47 cents in 30 years, where it can buy. It still looks like a dollar, it smells like a dollar, but it only buys what 47 cents buys. Well, the mortgage payment would be the same. If you were to implement a $750 a month mortgage payment, and you were to look down the road, each year that payment is going to feel, because you're earning new money, and inflation hopefully has impacted your paycheck in a positive way, and your dollars are feeling like they're less. It's less impact. It would be like if you had borrowed 22 years ago, and now you're looking at your mortgage. And what does that feel like? Well, if you look down the road at 30 years from now, that last year of the payments, the 308, it's going to feel like the payment's 750, but it's going to have the impact of 308. And your grandchildren's going to say, "What's your mortgage rate, Grandpa, Grandma?" "Oh, 4%. "Oh, whoa, wow. Look where we are, Grandpa." "I know. I was there once too. I was grateful that the 3%, 4% came out after a bad event in '08, but we were able to take advantage." So let's move on. The bank is watching your equity grow just as you are. Unfortunately, you're not only paying the bank interest, you're also paying the principal. When you transfer a principal to the bank, to the institution, you have now given them money that they are now going to earn interest on. This money was yours. They didn't ask for it. They asked for the interest or the payment on the 30, but extra payments would change things. But we're going to lose the interest on that principal. Even in the beginning of a 30, there's some principal. And paying any more that's necessary means that we're increasing our wealth transfer, that we're going to lose money that we could have accumulated interest. So we really have to be careful about how we tell what we do with our money. Let's say you made a $20,000 down payment, and you have the potential to earn 5% after tax or tax-free on money. Well, in 5 years, you have lost, because of that $20,000 you put down, $5,667 of interest at 5%. There was a cost for giving that payment to the bank. Well, what if you had made a 40 or an 80 or doubled what was required? That's the real question, that you put more than what was needed. You not only have the lack of liquidity of that money, the use of that money, the safety of that money, but you've lost the interest on that money for your life and your children's life. Wealth is built by keeping it, buying things effectively, efficiently, not by just earning new. Well, if we keep putting money into the bucket and the bucket's got leaks, we're not going to fill the bucket very fast, or maybe not at all. So we need to think about what we're doing, and that's where the financial coach comes in. So let's take a look at this. I love this screen. Here we have a mortgage, $100,000 at 6%. I'm going to use that to make a point that the mortgage interest rate has very little to do with the cost of the mortgage. That the monthly payment is $600, and in the contract, that would state, for this agreement, this arrangement, it would say that you would transfer $215,838 to the institution. All right. Monthly payments of $600 invested for 30 years at 6% equals, look at that big number. Well, I'm going to take it up here because a 6% investment may incur some risk. It may incur some taxes. So let's take a look at a tax-free environment at 5. That's what it would grow to. I think that's very good considering the features that come along with the tax-free world. But the money that we took out of the mortgage when we applied, and let's say this was the individual that we spoke of earlier who felt comfortable, secure with the mortgage, and I convinced them somehow to take a look at this option. But when you took the 6% mortgage for 30 years, your payment is 6. You have $100,000 that was put into your 5% vehicle, which now means you have $100,000 of liquidity. You could actually make this payment at 4%, this one right here, for 22 years. You're not out of control. You got the money for 22 years, and you would capture the tax deduction, which you did not when you had your house paid off. So you took the same money, you exercised it, it's earning, it made you $200,000 plus, if I'm not mistaken, and now you got a deduction. Well, I've done the math on this, not to do it right now, but if you were at the 25% marginal tax bracket in this situation here, you would have achieved a $32,000 additional mortgage deduction, real deduction, by filing the taxes every year on the 30-year fixed mortgage. Had you applied this to this account, this 100, this figure here, $446,000, would be increased by over $74,000 more. So you paid $215,000 for $500,000, and you had liquidity, use, and control. So we're going a little further. so far I don't see any expenses, so why choose the 15 over the 30? Well, this is a decision that I think by now you may not even feel you would want to, because if a 15 gets you to the payoff date before the 30, then the faster you get to the payoff date of owning the house outright, that would be the worst thing. Remember, if it works for $1, it'll work for many. If it doesn't work for one, it will work for none. So the interest we think we save, and we may have already learned we don't. The perception is that the shorter loan duration reduces the cost. Well, with lost opportunity, maybe it does not at this point. They have done a great job of convincing us of these features, but it may not be the truth, as we know. If you found out what you knew to be true was not, when would you want to know the answers? So paying cash for the house, I believe this would be an option that I hope at this point you've realized that you would express to your client that this would be a tying up of money and a maximum increase in the lost opportunity or the wealth transfer. That this is, and you're out of control. In a lot of cases, liquidity use control must be in every financial plan. So here's a $100,000 6% mortgage, a 15 and a 30. If you notice, there's $243 a month extra being paid into this one. And that means the $243 now belongs to the institution. They put it in their bank, their interest, or actually they lend it to our friends, to us, and now it's their money for them to benefit, and it becomes our lost opportunity cost. Had we kept this $243.86, put it into our 5% model, we would have a very good solution, because in 15 years, we would have been able to pay off the mortgage. But look what happens with money. A 15-year mortgage is paid off in 15 years and then gives you the extra 15 years to take the $844 and put it into your investment at 6%, and you come out with $245,409. But look at this. Had you bought the 30-year mortgage and took the $244 that was saved on the mortgage and applied that to the 30 years at 6%, you've got the same number. Money is funny, isn't it? Especially when it's mathematics and not arithmetic. So you've incurred, it's a whole lot harder to get a 6% average over a 15-year than it is to get a 6% average over a 30-year. If we're going to talk averages, which you may or may not, you know that I'm not a big fan of average, but it does give us a picture here. Okay, so we got all these different answers now. Enter in some assumptions here, but let's take a look at where we are. A conventional mortgage of $500,000 at 6%, the payment's $29.97, and the monthly payment on a 30-year over here, the 15 is $42.19. I'm sorry. So we have put out, wow, $1,100 a month extra into that bucket. Had we done it a little different with a 30% marginal tax bracket, and this thing is not active. Look at this. After 15 years, we would, if we had got a 4.2% net after-tax return on our money, we would have the money necessary to pay off the mortgage. We only need a 4.2%. So let's take a look at what happens. There's the graph. We have a mortgage. We're putting the difference between the 30 and the 15 into the side fund, and there's the point where we could pay it off. And we have, by the way, all the money in our account. Now we have to find an efficient way to transfer it to the institution, and through collateralization, we could actually keep our money and pay off the loan. So, assuming the side fund had a 6% return, there you go. Yep, we already done this. It went backwards. So, let's go forward, and there's our graph. So, by the way, that's the end of my presentation. I forgot. We have gone to the end, and the answer is the answer. I do believe I would see a very large increase in my tax deduction if you look down at the bottom over the 30, and we do fight for tax deductions, and anybody who buys a 15 is saying, I don't want it. Doesn't make any sense. It's a partner. Just like the mortgage interest deduction, everything else that we would use in the model to gain access to more money and reduce our lost opportunity are the tools that we would use. So I hope this was some help. I hope it did all of the right things in answering our questions, because if we were to look at them again, we would have 5 questions that I hope that each of us would never answer the same way, and that we would never, ever feel comfortable or secure about having the equity in somebody else's hands and actually losing our liquidity, our use, and our control. Aloha, and thank you again.